Hey, Jose. So I can see you're online. You can just do me a favor, confirm my audio is good and my video is good. That would be much appreciated. Excellent. Thank you. So you got a few more minutes before attendees start rolling in. Might as well get my screen up here. And hopefully my screen is sharing as well. Yep, I'll keep you posted. Hey, Nancy. See a couple of our attendees are starting to roll in. Give it a few more minutes before we kick off. Too many coffee cups lying around. We're going to give it a few more minutes for give the other attendees a chance to log in. With regards to mentorship, I want to add new accounts in QuickBooks. Do you have any guidelines or requirements, or am I free to add whatever accounts and whatever numbering I want? My recommendation would be if you are looking to add accounts to your QuickBooks account, I'd send them over to our bookkeeper, Jennifer, and just make sure you're using the numbering sequence and that they're set up in the right way. That's probably the best way to handle that. Okay, we're going to kick off shortly here. I'm just going to sort of get us queued up to go live on Facebook before we kick off today's session on the top 10 advanced tax strategies for corporations. I think this is going to be a good one. It's a new session. First time we've done it, so bear with me. Hopefully I'm going to get the timing right. But as I said, this is the first time we've run this session. Hopefully it will get you educated on some of the tax strategies that can help you keep more of your hard-earned money and eliminate some of the stress for you. So let me get us live here on Facebook, and then we'll kick off. We're almost there. I promise everybody. Okay, we are so close. There we go. Minimize that. So welcome everybody to our session on the top 10 advanced tax strategies for corporations. I hope you guys are going to find this to be a great session. The goal for today is just to educate you on some of these top strategies. Because we're going through 10 of them, it's going to be hard to be able to get really into the weeds, but hopefully I inspire you to reach out and connect with your accountants, because the reality is with these advanced tax strategies, they are really things that should be approached by working with a professional that's knowledgeable on your individual situation. So throughout the session today, I encourage you guys to participate. If you're not familiar with Zoom, which I think a lot of you are now, you can connect with us by either using the chat, you raising your hand to talk if you'd like, or most preferably using the Q&A feature. I will be looking first and foremost to the Q&A section, and then going to the chat, and lastly to the raise your hand. And the raise your hand feature is really for those of you who want to actually speak with me as opposed to typing out your questions. So that's just to get our little housekeeping out of the way. So for those of you who aren't familiar with us, my name is Andrew Wohl. I'm the managing partner at CPA4IT. We're a chartered professional accounting firm specializing in service-based businesses. Our goal is to help you increase your net worth and decrease your stress. We are an ISO 9001 registered firm, and we have, which for those of you who don't know, that basically means we've got systems and processes, and those systems and processes are audited externally, and those auditors make sure we not only do what we say we're doing, but that we're constantly striving for improvement. We are also one of the few firms that have been specializing in small business, and we have been doing that since my father founded the firm in 1984. We've also been recognized as an elite QuickBooks Pro advisor, which means we can give you some special pricing on QuickBooks and QuickBooks Online, as well as we've been recognized for the work that we've been doing with cloud accounting as one of the top 50 cloud accountants in North America for the last 5 years. Unfortunately, I think that designation is reached its final year as HubDoc has now been acquired by Xero, but we still love that claim to fame. The purpose of today's session is to introduce you to the top 10 tax strategies for corporations. These can get very advanced. They're going to range from really basic to really quite advanced. And I've done my best to try and arrange these in a bit of a hierarchy. So we're going to start with the low corporate tax rate and income splitting and income smoothing, which are really applicable to everyone and pretty straightforward. As we start to get into tax deferral, home and auto loans, insurance strategies, pension plans, capital gains exemptions, holding companies, these are far more advanced strategies and aren't going to be applicable to absolutely everyone, but they're great things for you guys to be aware of. And they're really amazing tools that can help you keep more of that hard-earned money and increase that net worth. So without further ado, I want to kick off by talking about the low corporate tax rate. And I don't know if this is really a tax strategy, but for Canadian-controlled private corporations that are claiming the small business deduction, the net tax rate here in Ontario is only 12.2%. Now, for other businesses that are not claiming the small business deduction, that's 26.5%, which is that's actually after the general tax reduction and the federal tax abatement. Without those reductions, the tax rate is closer to 49.5%. This is important to note because if you have any income that would not qualify for the small business deduction, most notably passive income, it could be subject to these higher tax rates. So there are some strategies that we're going to talk about today that can help make sure that you're fully optimizing your business to take advantage of the small business tax deduction. Now, the small business tax deduction is limited to $500,000. So that is something you should be aware of. Now, that is a limit on the net income, and it will be limited to all your related entities. So you can't go and create 2 or 3 different companies and multiply that small business deduction limit. You really only get that one limit, and it does have to be shared amongst the different companies that you have. And this is something that we help keep track of in our related and associated corporations. Now, there are a couple of things that you can do when it comes to the low corporate tax rate to help make sure that you are sort of getting the most out of that low tax rate. The first thing you can do is, ways you can reduce your corporate tax rate is by taking advantage of other tax credits. There's a number of them out there. The one that's most notable and makes the most sense for our clients is the scientific research and education tax credit. There are some other ones, things that are specific to farming, specific to tradespeople. There's a number of ones out there. CRA's got some great sites for being able to find out what those are. Really, when it comes to the IT sector, the biggest one that you're going to find that might be applicable is the SR&ED claim, or scientific research and development claim. The only other thing you can really do is make sure that you're maximizing your tax deductions. So every dollar that you have as a tax deduction or a deductible business expense is a dollar that you don't pay tax on. So really what you want to do is make sure you're doing everything that you can to optimize that. And looking at our benchmarking analysis is a great way to figure out whether you're being either overly aggressive or overly conservative. Now, this is just sort of meant to be guideposts. You can be below or above the average for very valid reasons, but it helps to at least pinpoint those areas where there may be opportunity. Now, I could spend this entire session on understanding what you can deduct, and we do have other sessions for that. So if you want to know more about what you can deduct as a small business owner, I encourage you to go to our events section of our website and get signed up for one of our bookkeeping sessions where we get into the meat and the weeds of what you can deduct as a small business owner. But I want to get into some of our other sessions because really I only have a couple of minutes apiece to cover these different sections because we've got so many of them to talk about. The other thing I want to talk about is tax deferral. And this is sort of related to the small business tax rate. So one of the big advantages that you get with a corporation, and this is again going to be available to everyone, is the ability to defer taxes. And what we mean by that is that this corporate tax rate is a huge advantage. But the one thing to understand is that when you move income from what would otherwise be personal income, like let's say a salary to you or maybe a dividend, and are able to leave it into the corporation, this is really a tax deferral. At some point down the road, you will need to take the money out of the corporation. But first of all, taxes deferred is a benefit because you get access to the time value of money. Secondly, the goal of a corporation is to optimize the tax planning so that we're taking this money out when you're in lower income tax brackets, most notably, or most usually, when you're in retirement. So when we talk about using your corporation as your private retirement savings vehicle, this is what we're talking about. We're talking about being able to leave money inside your corporation and pay only 12.2% here in Ontario and investing that with this sort of pre-tax or at least tax at a lower rate versus if you were to take that money out of your corporation and you would pay, let's say, the highest personal tax rate here in Ontario is 53.53%, you would have substantially less money to invest. And because of the way investments work with compound growth and compound interest, it would take a lot longer to grow that investment if you paid the full tax on it up front. So by being able to leave the money inside the corporation and deferring when you're going to pay the remainder of the tax when you take it till when you take it out of the corporation in retirement, it allows you to invest it and have that grow much, much, much faster. Now, again, this option is available to absolutely everyone, and it does make sense for everyone. But usually the biggest limiting factor here is your ability to leave money inside the corporation. Because as accountants, we usually have a trick or two up our sleeve, but we are still, constrained by what's actually happened throughout the year. So if you have taken out all of the money from your corporation and spent it on your lifestyle expenses, it really does limit us from that, one, taking advantage of that small business tax rate, and two, being able to take advantage of this tax deferral strategy. So those are the things you need to be aware of. These are fundamental strategies that are applicable to all of you and really are sort of the basics of tax strategies. But the key here is helping us to help you by doing your best to leave as much money in the corporation, which means if you have a partner who is a full-time employee, you want to do your best to look at the whole picture, the whole taxes for the family. And the goal would really be to use your partner's income, who's already been taxed, to maintain all your non-deductible lifestyle businesses, all your non-deductible sort of lifestyle expenses, and then use your corporation for those deductible expenses and for the savings that you're going to use as a family, right? That's a great savings vehicle because we can take advantage of that small business tax rate and this ability to defer taxes and invest those retained earnings or those funds pre-tax. So that's tax deferral at a really high level. Now I also want to talk about income splitting. And income splitting, has been a strategy that we as accountants have used as long as I have been an accountant. Unfortunately, there were some changes last year and in January of 2019 that enacted some new rules that made income splitting a little bit more difficult. So there's a couple of things to be aware of when we talk about income splitting. So first and foremost, as we talked about before, when it comes to tax savings, you really want to be concerned about not only your own tax, but the total taxes that you pay as a family. And so using income splitting can be a really effective strategy by maybe increasing the income to a partner, even if they have other income. If their income tax bracket is lower than your income tax bracket, we can still get some advantages. Now, when it comes to income splitting, because of these new rules, which are often referred to as TOSI, which stands for Tax on Split Income, it has made it a little bit more difficult. So there are effectively two ways that you can split income. First, there is the salary, which is usually the way that we recommend. Now, when you are doing income splitting in the form of a salary, the general rule is that the salary you pay to an employee must be reasonable for the work that he or she is doing on behalf of the corporation. It's also really important to put together as much documentation as possible, things like job descriptions, even timesheets or invoices are always helpful, as well as the actual flow of money. This is really, really important when we're starting to pay children and family members that are not your partner. Because with your partner, you got a bit of leeway there that the government recognizes that you might have joint accounts. But when you're paying children or parents or other family members, we really do need to see that flow of money going from the corporation to those individuals. So you can always pay them more than what we declare as salary, but we've got to have at least what you're paying them in salary been actually transferred from the corporation to the individual. Now, some of that you may choose to take into your own salary and drawings, which is you've always got that leeway and that flexibility. Now, what TOSI changed is it didn't actually change anything related to salary. This requirement for reasonableness and this level of documentation has always existed as long as I've been an accountant. What TOSI really changed was how we split income when it comes to dividends. And with dividend, the new tax rules basically create effectively three sort of levels of income splitting through the use of dividends. And the important thing to note about TOSI is it doesn't preclude you from giving dividends to any shareholders. It just says that if they are subject to TOSI, the shareholder will pay tax at the highest personal tax rate, basically eliminating all the benefits that are available to income splitting. So the goal of income splitting is to obviously use up lower tax brackets. All the income's taxed at the highest tax bracket, there's not really an advantage. So with adult income splitting, if you're incorporated and you dividend income split with your spouse, or your children, they must work 20 hours or more per week during the last year or any prior 5 years in order for that split income to be excluded from the TOSI rules. If they work less than 20 hours a week, then income paid to that spouse must be reasonable for the work that the spouse has done. So this gets into that reasonableness thing. Now, generally speaking, if you're going to be relying on reasonableness, our recommendation is to go the form of salary. It's been a little bit safer. We have some precedents to work on. We don't really have much in the way of precedents when it comes to reasonableness for dividends. In theory, it would be very similar to what's reasonable for salary, but I personally wouldn't want to be the one to set the precedent and create what CRA is going to be, what they're going to be considered to be a reasonable return. Now, they do have some criteria out there, which is basically that work is performed in support of the related business, the property is contributed, or if you're contributing property, which is another option, that the property is contributed directly or indirectly in support of the related business, and that the risks assumed are assumed in respect to the related business, that the total amounts paid or payable by any person or partnership to or for the benefit of the individual in respect of the related business, and 5, finally, that such other factors that may be relevant. This is a bunch of complex criteria. It is an area that like I said, would be avoiding. Now, for adult children aged 18 to 24, basically the new TOSI rules have basically made it completely impossible to do income splitting tax effectively. So basically the split income in excess of a reasonable return based on the contributions of these adult children will be subject to the TOSI rules. So this effectively, like I said, means you can't really do income splitting for people 18 to 24. Now, a lot of you might be wondering about children under 18. That was already eliminated several years ago by what's referred to as the kiddie tax. And basically TOSI is just effectively expanding beyond the kiddie tax. Now, the last exception we do have for this, I'm sorry, I'm getting ahead of myself here, scrolling on the wrong thing, is dividend income when you are over 65. So amounts received by the individual spouse, if you are over the age of 65, will not be subject to TOSI if, a whole bunch of other criteria. So basically, once you hit 65, you can income split with your spouse. So these tax rules are quite complex. And when it comes to income splitting, which is obviously something that we're really concerned around this time of year as we do final source deduction planning, I really strongly encourage you to reach out and connect with your financial professional, your account manager, and make sure that you're assisting with that. Now I'm realizing I'm not going quite fast enough, so I'll try to move a little bit faster, or else we're going to be here till like the end of the day. So the other thing I want to talk about is income smoothing. So income smoothing, it's a bit of an umbrella term that's used for various techniques used by accountants for sort of controlling that and hedging against the effects of peaks and valleys that happen with either corporate income or personal income. So there's things that we can do as accountants to sort of hedge against that. One of the most notable things that we have for income smoothing is that when you're with a corporation, we have the ability to declare income or salary anytime throughout the fiscal year end. So you can imagine if your fiscal year end is any day other than December, you're right off the bat effectively straddling 2 years. So you've got a little bit of play into which year that salary goes into, and along with that, which year you declare the expense from. So you might have a year where you've got maybe really high income, and what we'll do is we'll declare salary for this year and maybe also for 2021 as well. And with salary, we also get one extra advantage that we don't get with dividends, and that's the ability to do a bonus. So we can bonus income up to 173 days, or I think it's 173 or 183 days, basically just shy of 6 months. And that allows us to if you've got a year end in July 31st or later, push that income into the next calendar year. So effectively, if you're of a corporation that's got a year end that's July 31st or later, you have the ability to declare income in effectively 3 calendar years and expense it all in one fiscal year. What I mean by that, let's take, for example, a July 31st, 2020 fiscal year end. So the July 31st, 2020 fiscal year end starts August 1st, 2019 and runs till July 31st, 2020. So first of all, we could declare salary anywhere from August 1st all the way until December 31st of 2019. We can also declare salary anytime from January 1st to July 31st of 2021. Plus, we can bonus out up to 6 months, which would be anywhere from August 1st, 2020, all the way up until it ends up being like January 23rd or 24th, which puts us into the next calendar year. So you've effectively got the ability to declare salary in 2019, 2020, and 2021. And this is how we can use income smoothing to avoid those peaks and valleys. And we can do this both on the corporate side as well as the personal side. And this is good primarily on the personal side, because the personal tax system, we've got marginal tax brackets, which means, 1 year of $100,000 and 1 year of $20,000, the tax on those 2 years would be more than the tax on 2 years of $60,000. So the more that we can smooth that income, the lower the tax we will pay overall. Now, smoothing it within a corporation, there is an advantage. It's not as great because basically the tax brackets are really more about that small business deduction threshold of $500,000. So that's a really key factor. Now, we do have some play in, like I said, being able to control how much tax we pay today and reducing the tax we pay today, which might give us some time value of money. So if we're short on cash flow, we might be looking at strategies to minimize the amount of tax we pay today. So that's income smoothing in a nutshell. Now, I also want to talk about home and auto loans. These are another strategy that can really help with income smoothing. So one of the things is that one of the options that you have available is that the Income Tax Act specifically allows corporations to enter into bona fide loans with employees for the purpose of purchasing a home or vehicle, as long as such arrangements are properly documented. And these can be an excellent way to really and effectively pull a large chunk of money out of your corporation for the purchase of a vehicle or the purchase of a home without having to take that into personal income. So what we can do is effectively take that into personal income over a much longer period of time. Say with a house, we might do that over 20 years. So again, like we said earlier with income smoothing, the more time that we can smooth that income over and keep you away from these peaks and valleys, the lower the total overall tax. Now, when it comes to home loans, we have to be really, really careful, home and auto loans, because there are very specific rules around how we do this. And there is a risk that this home loan could be deemed to be a shareholder loan and not an employee loan. So you're basically receiving the benefit because you're a shareholder, not an employee. And there's a bunch of documentation that we've got to put in place and a bunch of steps that we have to follow to make sure that it's not assessed to be a shareholder loan. So that's something that we definitely want to take advantage of. But again, make sure you work with your accounting team to make sure that that is structured correctly. Now, as we get anywhere beyond here, these are really going to be strategies that you need to work with your financial professional. And we might even need to bring in additional financial professionals like tax lawyers and insurance agents. Now, insurance strategies are quite numerous. There's a lot of strategies that can be used by corporations, whether they're just regular, whole life investment or insurance plans, to things like the ICE maneuver, which is basically a leveraged life insurance policy. Now, this leveraged life insurance policy that we're referring to as the ICE maneuver is a really, really interesting one that we've got in play right now, but it's not for everyone. It's a strategy that effectively allows you to get a large chunk of money out of your corporation by borrowing against the life insurance policy. Now, I've got my first Q&A that's coming up here, and I'm going to come back to that ICE maneuver in just a second. When using the HST quick method, is the money saved from not having to remit the entire amount collected considered income? If yes, is that amount taxable at small business rates or higher? So yes, it is. So it is going to be considered income to you. We call that sundry income. That's the difference between the HST that you collect and the. So it's the difference between the HST that you collect and the HST that you have to remit to the government. So the quick method, which we could do a whole session on, is slightly different from the long method, where you take what you collect and you subtract what you've paid in the various on the various expenses that you have that we call ITC or input tax credits. So yes, it will be taxable to you. That is taxable income. So hopefully that answers your question there. So now getting back to this leveraged ICE maneuver strategy. So I'm going to give you the really high level. And again, if you're interested, you've got to speak with an insurance agent who can give you the nuts and bolts of how this works. So with a leveraged life insurance policy, what happens is the bank will lend you money personally. They will use as collateral a life insurance policy that the corporation is going to purchase. Now, you take that money that's been lent to you personally and you deposit it into your corporation. That creates an advance or a loan to the corporation that the corporation owes you money back for. The corporation then uses those funds to purchase a life insurance policy. Then, because you've deposited a large chunk of money into the corporation, which has been loaned to you from the bank, you can withdraw your own capital that you have in your business for maybe a big renovation or your children's wedding or whatever it is that you want to get access to those funds for. Now, the loan continues to accrue interest that you don't have to pay typically until death, and the insurance policy continues to increase in value. Upon death, basically the insurance is paid out to the beneficiary as a capital dividend account, which is tax-free. So when you receive funds paid out of insurance, it is tax-free. It comes out of the capital dividend account. So this allows you to pay off that loan that you have and maybe even have some additional funds depending upon the value of the insurance policy. And you have to work with actuarialists who will tell you, they'll plan the whole thing out, and based on your lifespan and at different points, there may be a delta between the value of the life insurance versus the debt that you'll be accumulating with the bank. And they'll show you how that works out over all the different years. But the big advantage that you're getting is you don't have to pay any tax to get that money out of your corporation. So this is not a completely free maneuver. There are costs and they can be expensive, but you're going to get a huge tax advantage that's going to more than outweigh the cost of it. Plus the cost is deferred until death. So that's the one example of an insurance strategy. There's lots of other insurance strategies that can be used. And if you're looking for a real estate person to work with, we'll be happy to introduce you to someone. Now, another thing that is a really big advantage is pension plans. So IPPs are something that have been around for a while. These are what are called individual pension plans. And this is a type of sort of defined benefit pension plan governed by provincial pension legislation. And each IPP has to qualify for registration as a pension plan under the Income Tax Act. But they are really beneficial for high income earners because they allow you to make contributions that are normally higher than what your RRSP contribution limits are. And what happens with an IPP is it's basically an expense deduction to the corporation. So it reduces the taxable income of the corporation. And this is a really, really great strategy for anyone who's approaching that small business deduction threshold that we talked about, because IPPs can be a great way to add in some additional expenses to hopefully keep you below that threshold. And what happens is this accumulates in a pension plan that gets paid out upon retirement and that gets paid out obviously to the individual person that the pension has been created for. The contributions are all based on age, employment income, and there is a correlation to your RSPs because basically pensions, if you contribute to your pensions, they're like contributing to your RSPs, they reduce your contribution limit. But you can get more pension room than you can get RSP room. So they are really good strategies for those people who have maxed out and are completely topping out RSP strategies. Plus they're creditor proof, which is a great advantage. And the contribution fees and the administration fees are all deductible as well. What else is there to know and make sure we're aware of when it comes to this? You can deduct any interest for money that you've borrowed to fund these contributions. Those are deductible as well. You can usually bring in spouses as well into these, but they're all custom tailored. Now, the one thing is that you should be aware, the only downside is that these assets in the IPP are locked until retirement, so you can't really get access to them until retirement. So they're really for high net worth individuals, and also sort of on the negative side, these are sort of expensive to manage and run. So there are quite a bit of costs. So there's advantages, but there's also disadvantages. So again, if this is something that you're contemplating, really you want to reach out and speak with us so we can connect you with the experts in this. Who takes loan, corporation or individual, because the insurance is taken by corporation. So basically you're talking about this ICE maneuver again. So this ICE maneuver, you personally are taking the loan, which is what allows you to deposit the money in to the corporation as a director's advance, as a loan to the corporation. So it's a bit of an unusual situation, and it's the way accountants are able to sort of have a trick up their sleeve or play shell games with money, but it is a perfectly legitimate tax strategy. So basically, you are getting a loan personally, and it's the corporation that owns the asset. But because you're the beneficiary of the life insurance policy, the bank is still willing to lend you the money, even though it's the corporation that has the life insurance policy. So Vanette, I know you're asking for an overview of the tax credits. Can't really do that in the limited time that we've got. What I'll try to do is I'll maybe post into our Facebook group a link to a great website, or a great link on the CRA website, where you can go in and put a little bit of information, and it will tell you about not only all the different tax credits, but all the different subsidies and all the different programs that are out there. So I'll share that with you, which I don't have that memorized, but I'll make sure to get that into the Facebook group. So if you're not already members, everyone, please log in and join our Facebook community, facebook.com/groups/the Self-Employed Support Network. Oh yes, one last thing I also want to mention is with pension plans, there's now a new thing called a personal pension plan. This is really interesting because it allows you to, instead of just having an IPP, which is, as we mentioned, a defined benefit pension plan, and PPP allows you to basically move back and forth between defined benefit and defined contribution. It just gives you a little bit more flexibility. I have a friend who from Integris, JP Lozano, who's sort of the creator of the personal pension plan, or at least one of the first people I know whoever rolled it out, most knowledgeable person. Again, if this is something you're considering, I'd be happy to arrange an introduction, and he can walk you through all the pros and cons. Lastly, I do want to also talk about the lifetime capital gain, or this is, sorry, not lastly, but I do want to talk about the lifetime capital gains exemption that is available to shareholders here in Canada. So if you sell shares in a qualifying Canadian business or a CCPC, Canadian Controlled Private Corporation, right now in 2020, the lifetime capital gains exemption is $883,384,000. So normally when you sell shares, that's going to be subject to a capital gain Now, beautiful thing about capital gains is you're paying tax on that, but you actually only pay tax on about half of that. With the capital gains exemption, you're going to pay tax on none of it. So effectively, because you would normally only pay tax on half, this is saving you the tax that you would pay on $441,692. Now, there's a couple of key criteria when it comes to the capital gain exemptions. And there's two main rules that I'm going to actually take the time to read because they're pretty important. So one is regarding ownership of the shares, and the second is regarding the use of the assets of the corporation. So throughout the 24 months immediately preceding the disposition of the shares must not have been owned by anyone other than an individual or a person or partnership related to the individual. The shares may be newly issued shares that have not been owned for a full 24 months. So they don't have to be shares that have been in existence for 24 months, but they must not have been owned by an unrelated person or partnership in that period. Unfortunately, section 110.6/14 deems these newly issued shares to be owned immediately before their issue by an unrelated person or partnership, unless the shares were issued, one, as a consideration for other shares, or two, as part of a transaction or series of transactions in which the person or partnership disposed of property to the corporation that consisted of, one, all or substantially all of the assets that were used in an active business carried on by that person or the members of that partnership, or two, an interest in a partnership, all or substantially all of the assets of which were used in an active business carried on by the members of the partnership, or three, as a payment of a stock dividend. So like I said, this is why I had to read this stuff. And there's still that second section, which basically says, throughout the 24 months immediately preceding the disposition of the shares, more than 50% of the fair market of the assets of the corporation must have been used principally in the active business carried on primarily in Canada by a corporation or a corporation related to it. At the time of disposition of the shares, all or substantially all, 90% of CRA would call it, of the fair market value of the assets must have been used in the active business income. So this is really important because you've got a bunch of investments in your business. You want to really separate those out to a holding company, which we will talk about. Otherwise, you risk losing that capital gains exemption. Examples of assets that may not qualify as being used in an active business income are stocks, bonds, and rental property. And then there's a whole bunch of stuff about if the individual dies and is deemed disposal of the shares at the time of death, the shares may not be qualified small business corporation shares because of the 90% rule. In this case, the Income Tax Act does provide that the shares may still qualify if the corporation was a qualified small business corporation at any time in the 12-month period before the death of the individual. In addition, there is also a non-arm's length criteria that basically says, my dad can't take advantage of the capital gains exemption because he's selling to a non-arm's length individual. And again, we're already running a tad short on time, so I'm going to skip over that part completely. But the capital gains exemption really is an important thing to consider. The thing you want to keep in mind, if you're ever going to consider selling shares in your corporation, have you set up your corporation properly? Now, a lot of IT consultants, you're probably never going to be selling your shares of your business because you don't really have a saleable business. Now, if you are a software developer or an app developer, this is a different story. You may have a saleable business here. So you really want to make sure that your business is structured properly. Do you have a class of shares for yourself and usually your wife? Whereas an IT consultant, you probably would have a preferred share for your wife, but not a common share. Whereas if you're planning to sell your business down the road, we want to maybe set you up with two different sets of common shares. Looks like we've got some more Q&As coming in here. Next time, type up or show the rules on the screen. I intentionally did not do that because I don't want you guys distracted. What I will make available is the slide deck, which has all this information available. I personally do not like having all that content on the screen. I like my slides to be clean and clear cut, so you guys are paying attention to me, not the screen. I'm lost with regards to capital gain exemption rules. So for those of you who are lost, this requires more reading, and I'm happy to share the slide deck, which has the details in it. As well, we are more than happy to book a consultation where we can go into the weeds. And of course, your best friend in the world, Google. You'd be amazed at the content that you can provide on CRA's website related to this. Okay, so capital gains exemption, I think we've really covered that. Now, holding companies, which is our last section. Now, holding companies are arguably one of the most important strategies that are available to us. As we mentioned earlier, they're really important when it comes to this capital gains exemption for separating out the investments from the active business so that we are still eligible and we can show that 90% of the business income is generated from active business income. So first of all, I guess the first question is, what is a holding company? And a holding company is usually an entity that's created for the purpose of gathering various assets. Could be, real estate, shares, other assets, or even other companies under sort of an umbrella. And this allows you a lot of advantages. So there are a couple different types of holding companies. Generally speaking, these are going to be investing holding companies as opposed to operating holding companies. But for you guys, the advantages of the holding companies in Canada is that you can have enhanced protection against creditors. So you're limiting your liability in your operating business to the assets of that operation, and you're moving out the retained earnings or the value of your business up into a separate corporation. And this is done very tax effectively by using dividends. And the dividends that you pay to your holding company are tax-free dividends. So this is a huge advantage, as well as, like we said, the other big advantage of being able to shelter and protect this capital gains exemption, because if you had everything sort of intermingled, your investments and your operations together, first of all, any risk that you're exposing yourself to in your operations puts your capital that you've spent all these years saving up at risk. Whereas if we shelter that and protect that in a separate holding company, creditors might still be able to come over after the operating company, but they can't come after the holding company. It provides some extra protection. And in addition to this, we've got some tax maneuvering that can provide us some advantages. So as we said in our very first slide, is that the small business deduction, which allows us to pay only 12.2%, is not applicable to passive or investment income. So when we have passive or investment income intermingled inside of an operating company, what CRA will do is they will typically apply the expenses that you have against your operating income first. We've got a little bit of leeway on that, but it's marginal. And then if you wipe out all of your operating income, then and only then do you start to erode the tax on the passive income. But when we have the operating income separated from the passive or investment income, what we can do is we can take your salary from the holding company such that we wipe out or eliminate that passive income, which would normally be taxed at a higher tax rate. So a holding company can provide a financial advantage as well as these non-financial sort of asset protection strategies that are available to us through minimizing and reducing the amount of tax you pay on passive income. So now you have passive income over here that's been offset with the salary that you're going to pay yourself, wiping that down to zero. Now you've got your operating income over in the other business where you're now not taking a salary because you've taken it over here in your holding company. As a result, you have a higher net income in this operating company, but that's taxed at a lower rate, which ends up being a better tax advantage for you, as well as the benefit of limited liability. Now, the only real downside to a holding company is you've created a whole separate second legal entity. And now you have the paralegal costs for setting up and incorporating that. You've got your ongoing accounting costs to make sure you're compliant with CRA and filing everything on time. You're now getting 2 sets of brown envelopes every year, or every quarter, depending upon your situation. So those are the things that you need to really be aware of when it comes to setting up these holding companies. Now, I've gone through a lot of different tax strategies. I know some of it I flew through very quickly. I was trying to figure out my timing, get my feet and my feet grounded here in the first time running through this. So appreciate your patience as we ran through this. I am going to open it up for a little bit of Q&A now. So if you guys do have any questions, please feel free to post them in the Q&A. I know there were some questions as it related to the capital gains exemptions. And so I really want to drill into this. So, I mean, the high level, like, it's complicated, and really you should speak to your accountant if you're looking at this. But first and foremost, if the shares have been owned by someone else in the last 2 years, that could make them ineligible. If you're earning income that's not all coming from operations, that can make it ineligible for the capital gains exemption. If you're selling to non-arm's length people, that also it can eliminate the capital gains exemption. Now, the one thing is, this capital gains exemption sounds amazing and sexy because you're saving potentially the tax on $441,000, or make it sound even better by telling you the capital gains exemption is $883,384. But keep in mind that this requires you to find someone who's willing to buy the shares of your business, not the assets. So this only works when you sell the shares of your business. And this is great, but unfortunately, a lot of purchasers don't want to buy shares. They would rather buy assets, because when they buy shares, they basically take on all the risk that's been created in the past with any pre-existing creditor issues that might be out there, because they're buying the shares of the company and they're not buying the assets. When they buy just the assets, which could even be, could be physical assets, could be goodwill, there's a lot less risk for them. So usually if someone is going to buy shares, which is, most purchasers don't want to buy shares, they want to buy assets. But if they're willing to, they're probably going to pay you less. So there's this whole trade-off of pros and cons. If you are even remotely considering selling your business, first and foremost, I'm going to encourage you to go through our value builder system to help you get the most value for that business before you do sell it. Secondly, I'm going to strongly encourage you to have your accountant work with you through the due diligence process of that sales cycle. Yes, there will be some additional accounting fees involved, but it will help make sure that you're maximizing the tax strategy around the sale of your business and doing that most effectively. So I don't see any Q&As coming up. I do see a couple things in the chat, so let me pop over to the chat. Wages versus dividends, for example, for 20K. So salary versus dividend, this is not really an advanced tax strategy, but it is something that we get asked quite a bit on. So a salary is an expense to the corporation and reduces the amount of taxable income the corporation pays. Because the corporation pays no tax on this, the employee pays the full personal tax rate at whatever their marginal tax rate is. Now, a dividend is different. A dividend is paid out of retained earnings. It comes out of your balance sheet. And what that means is the retained earnings are the income that the corporation has paid tax on already. Now, it's only paid tax at 12.2%, which is lower than the personal tax rate. Now, what this means is when you as a shareholder receive a dividend, you're going to also receive a dividend tax credit to help offset the taxes that have already been paid. Now, there is something called the theory of integration, which is intended to make it so that there is no financial advantage to an owner manager choosing one strategy over the other. So effectively, when you net out, the corporate taxes plus the personal taxes on a shareholder receiving a dividend, and compare that to the personal taxes of an employee receiving a salary, they should be fundamentally the same, give or take a few dollars. And we've had people who've run, multiple calculations. Imagine we've got IT consultants who have built whole spreadsheets trying to analyze this, and accountants all over the world trying to figure out if there's a benefit, well, all over the country, trying to figure out if there's a benefit. And there really isn't a financial benefit unless there's other extenuating circumstances. So the other extenuating circumstances really come down to the profitability of the firm. So first and foremost, dividend can only be issued if there are actually enough funds or retained earnings to issue a dividend. So you cannot issue a dividend to create a loss in your corporation, first and foremost. Secondly, if you're going to have a loss because of expenses, it might be better if they're pre-existing retained earnings to pay that out in the form of a dividend. And that depends on the individual situation, because sometimes we can carry those losses backwards up to 3 years. But if there haven't been taxes paid or profits in the last 3 years, then there's nothing to apply those losses against. And then those losses will carry forward, which you may in the future be able to apply gains against those losses, but you may not, right? So we might switch over to a dividend strategy there. The other time that we might consider a dividend strategy is if for some reason you don't believe in RRSP or CPP, which I personally do think those are effective strategies that you should be making use of. But a dividend is not eligible for RRSP, so it's not going to build up any RRSP room the way a salary will. And it's not eligible for CPP, meaning you don't pay into CPP, but you also, because of CPP as a pension, not a tax, you also won't receive as big a benefit if you're not paying into it. So we are big believers in both of those strategies, and we like to create a whole plan that encompasses your entire financial perspective, which is not just your corporation. It's your corporation, it's RRSPs, it's tax-free savings account. Sometimes it's unregistered, sometimes it's IPPs. We want to create this whole plan that's making use of all the tax strategies that are available to us to make sure that we're doing everything we can to minimize the amount of tax that we have and increase the amount of net worth that you're going to have. So again, Vanette's asked this question in a nutshell about the overview of the tax credits. I have a few more minutes so I can talk a little bit about what some of those tax credits are. So let me go back up to our first slide. So let me just mention a couple of them. So there's the probably the best known, as I said, is going to be the research and development tax credit. But there's tax credits for farming and fishing for certain parts of the world. There's tax credits for creating childcare spaces, or there's also tax credits for hiring apprentices. There's a couple out there. Like I said, the one that's really going to be most notable in the IT world is going to be the SR and ED. For those of you who are not familiar with the SR and ED, this allows you to get tax credits for money that you have spent on work that the government believes is helping to develop, create research and develop Canada's scientific expertise. There's a whole bunch of criteria for qualifying for this. If you're ever going to go down this road, we have a firm that we work with quite a bit on our SR and ED claims. They're called MEUK, and we've worked with them for a number of years. They are experts in this. They often work on contingency basis, which means they will prepare the shred claim, and they will get paid as a contingency or a percentage of what they get back for you. They'll help you figure out whether they think that you're going to be eligible, so you don't waste your time or their time in going through the claim if they don't think that what you're doing is going to qualify as scientific research or development. And they'll help you to maximize it, because there are certain things that you can do, like, you want to be taking salary as opposed to dividends instead of consulting fees, to maximize these, and things you have to do to document your time that you're putting towards it. So there's a whole rigid process, and that's typically done by specialists. We don't do the shred claim, but we do work with our shred partners, because there's a portion of work that they prepare that we file on the tax return. But accounting, much like medicine, you really want to make sure that you're hiring a specialist. I wouldn't go to a foot doctor if I was having chest pains, which is why you don't want to go to a generalist. When it comes to SR&ED, you want to go to a specialist on that. Just like we bring in tax lawyers when we have, complex tax formations and tax structures that we want to create, which, around a typical holding company, we've got a standard format that we will create, but we can get into more complex structures depending upon the individual needs. So we got one more question that's popped into our Q&A. The home loan does not have to be paid by the end of the next financial year of the corporation. It can be further extended for more years. Can you explain this a little bit more in detail? Absolutely. So a home loan is a loan agreement that you enter into between an employee and the corporation. And there are prescribed interest rates and repayment terms. Typically, those repayment terms are going to be comparable to what you will find in the market. So for a home, that might be 20, 25 years, something in that range. So effectively, you're repaying that into your corporation over 25 years, as opposed to it having to be repaid within the normal, 1 to 2 years that you have with what we refer to as a net debit balance or a director's advance. So with the director's advance, when you take money out of your corporation throughout the year, we have a little bit of flexibility in that you don't necessarily have to pay it back by the end of your fiscal year. You do get the ability to carry out what we call a net debit balance for 1 year, which would mean that you would have until the end of the next fiscal year to repay that loan. But in that next year, your director's advance does need to be closed down to zero, or from a director's advance to a shareholder loan where the corporation then owes you money. But with a home loan or an automobile loan, these loans are set up for much longer periods of time. These aren't shareholder loans, or what we refer to as the net debit balance. So the shareholder loan has very specific rules where it has to be repaid within that effectively that 2-year period we talked about. A home loan or an auto loan is effectively an employee loan. It carries with it some taxable benefits that need to go on to your T4. So there are some different ways that we do that. So you have to obviously remain as an employee as long as the loan exists. If you go back to full-time employment or the employee leaves, then the loan would need to be repaid. So that's one of the big things you do need to be aware of. Hopefully I've answered that question. Now, the other thing to note about a home loan is it can only be done in the year in which you purchase the home and in which the employee purchases the home. So it can't be done for a renovation or a remodel or something like that. It doesn't have to be your primary residence. It can be done for cottages or secondary homes, but it cannot be done for investment properties. So again, if you're considering this, these are where we're getting into advanced tax strategies for sure, but they can have a huge impact on reducing the amount of personal taxes that you're going to end up paying, because you're not taking all that money that you want to put as a down payment on your home into your personal salary. But if you're considering it, I encourage you to reach out and connect with your financial advisor, your account manager or a financial professional, and make sure that that's being structured correctly. Now, hopefully you guys found this useful. If you did, please share in the comments. Do you have to pay a huge capital gain if you buy a secondary property? So this is not a corporate tax strategy, but yes, if you own more than one residence, may or may not be a huge capital gain, but your primary residence is capital gains exempt, which means you pay no tax on the sale of that house of your primary residence, which is amazing. Unfortunately, if you own more than one property, that second or third property, you will pay tax on the gains that you receive. Now, it's going to be a capital gain, which means at the moment you will pay tax on only half of that. But if you buy a house for $300,000 and then turn around and sell it for $500,000, you've basically got $200,000 of capital gains. So you'll pay tax on $100,000. And that's personally, Mira. So these properties would be owned personally. Now, an investment property, if you happen to own an investment property inside your corporation, which some people do, and there are advantages and disadvantages of that, then any properties owned inside the corporation are going to be subject to a capital gain. And again, we'll get that same rate where it's only paying tax on half of it. So I'd love to know, hopefully, did you guys find this helpful and informative? I'd love to know your feedback as to what we could do to make it better. This was our first kick at the can. I'm really excited to hear from you guys as to whether it was a good session, you found it useful, it's something that you'd come back for. So please do share your comments. And if you don't have any other questions, we'll probably call it a day. Excellent. Okay. No problem. I'm glad it was hopefully helpful to you, Mira. Bye for now, everybody.